Welcome back to all our listeners for another podcast with Gold for a New Generation. Today is June 21st, 2021. This is our 11th podcast. My name is Rafael, and I'm here with Steve Skulls. And the subject of the podcast today is how can inflation affect the price of gold? Steve, how are you doing? It's been a while since we last spoke. How have you been doing?
Doing pretty good. It has been a few months since we last spoke, and I just got my second vaccine shot. So hopefully our viewers are all getting their vaccines. I do feel a little bit not 100% after the second one, and also I have probably read about a dozen financial history books, amongst many other
Wow.
books. But just I think we're at an interesting time in financial history, and I've just gone back and read a few of the classics and just kind of reliving how crazy things have got in the past in financial markets and seeing how they relate to this current moment in time.
Cool. Speaking of the books you've read, is there one in particular that stood out?
Well, I've read a few books about 1929, the crash of 1929. Interesting fact that I didn't know: Winston Churchill had made a whole bunch of money in the 1920s, and he lost it in the crash of 1929. Winston Churchill. So he had to go back to work, and he eventually became prime minister again, or maybe for the first time. But he had been prominent in British politics and military, and then he came back because he had lost all his money in the crash of 1929, and in a way, kind of led Great Britain against the Germans. So that was a little fact that I didn't know. Maybe one of the good things of the crash of 1929. I can't remember the title of that book. I've read a number, but there's another book, Devil Take the Hindmost, the history of financial speculation, which is kind of like, the last one out the door kind of gets killed, when you're into that speculative mania. So that's another one. So those are, some of the things that I've, if you want a good financial history book, Devil Take the Hindmost is a good one. It was written actually at the peak of the dot-com bubble about 20 years ago. And I think it's a timely book to read right now.
Okay, cool. So today's subject is inflation. Uh, we've been speaking about inflation ever since we started a podcast. With the coronavirus, a lot of countries are going through a lot of stress, and one way to deal with it was to print a lot of money and hand it out to businesses and people so they can spend it on whatever necessary things they need. And that would help stimulate the economy and help it keep it going. So we've seen since the promises of stimulus packages that they did happen and people did get their money. And so obviously there's a lot of extra money, nominal money supply out there today compared to pre-COVID times. And with that, we know that this could cause inflation, the depreciation of the currency. And the reason this is important in our podcast is because we're interested in investing in gold, and gold is known to be a good hedge for inflation. Now, on a personal experience, more in the past short-term period, I've started to read more about inflation through news and headlines and well-known investors and people. For example, Warren Buffett in his annual meeting of 2021, just an example, also spoke about inflation. And so, yeah, it's an appropriate time to speak about it in our podcast. What are some of your insights?
Yeah, so I think it's become a really prominent topic. Everyone, it seems like, is talking about inflation and lumber prices and copper prices, and they're becoming really worried about inflation and hedging their portfolios for inflation. And this is something that we've been kind of hinting was coming, and now it seems to be here. Now, I think there's a lot of caveats to put around that, because I'm getting lots of people texting me and saying, "Oh, well, now I get investing in gold, and I should be doing all these things, and I'm missing out if I don't have more money in it." And here's the caveats that I see. So the first thing is, inflation is probably somewhat overstated at the moment. People are hearing about 5% inflation. Well, part of that is, we had prices actually decline in March and April of 2020. And now when we compare 12 months, we've kind of got this temporary decline versus, the level they are now. And it looks like it's 5% annual inflation, when really, if we looked at an 18-month period and annualized it, it might be more like 2.5% inflation. So it's not quite as significant as the headlines show.
But one
Uh,
note there, it could continue in that trend.
yeah, that's right. I mean, that's what people are doing. They're kind of extrapolating that, and that's important because as we've talked about in the past, that a certain part of inflation is just the psychology of it. That if you expect prices to rise, stores start to increase their prices, and people start stocking up on stuff, and all of a sudden that extra demand causes prices to rise. So all of those things are true. They could continue. Um, but also, I mean, there is some aspects of just simply supply, temporary supply shortages, where you had factories and things shut down for 2 or 3 or 4 months, and now that demand has come back on, but the supply is not there. So that's creating some noise. But also, I think a really important caveat is, when everyone, and I'm starting to see in very kind of outside of the investment world, just typical news shows talking about inflation, and almost everyone getting concerned about inflation. It may be that when everyone gets concerned about something, they've already positioned themselves for it. It's priced into the market. It's maybe overpriced into the market, and you have to be careful not kind of jumping with that herd when everyone's concerned about inflation. Because if you go back a year ago, no one was talking about inflation, and that's when it was the time to buy inflation hedging assets like gold and other things. Um, and it's important, that we spend a little bit of time on this. And um, I watched a news program last night, and it was a Fox News opinion host, and he was describing to everyone, well, what's going on. It's all, the U.S. President Biden is spending all this money, and it's the U.S. dollar is dropping, and that's forcing prices up, and we've got to be really worried about inflation because of what Biden is doing. And when that kind of sentiment gets so out there, and just not even business programs or internet sites, but just the regular news is talking about it, that sentiment is maybe getting a bit extreme. And that's important. If we look back in history, 1970s was a time when we had a lot of inflation, lots of concerns about inflation. And if you go back to the mid 70s, there was even a program that Jimmy Carter had started where it was whip inflation. And they gave everyone these buttons to remind everyone, we got to, somehow manage inflation. And within that time frame, gold fell from $200 to $100. And then it proceeded to go up to $850. So that was kind of 1976 when that drop happened. So even if we have inflation, even if it's trending up, if people get too concerned about it and invest too aggressively in inflation assets, that can kind of create some fragility and see prices drop. And I'm just going to share with you a survey that was being talked about on the news as well. And again, it's not often these kinds of things get in the news. Just going to find the page that I want. I think it's here. Yeah. So this is a study by Monmouth University, And one of the questions they asked, and this is what was covered on the news, it's not just the survey itself, but the fact that it, was a significantly discussed kind of news topic, was, how concerned are you that these spending plans by the US government is going to lead to inflation? And if we look at the stats, and this was just done in the last week or so, the stats were 47% very concerned, 24% somewhat concerned. So almost 75% of people are concerned. And that's pretty extraordinary sentiment. And often in markets, when you get that really extraordinary public sentiment that this is, something's going to continue, is often when you want to go the other way. And I'm just going to give you, an example that everyone is talking about, right? Everyone, you can talk to anyone about lumber prices and how much lumber prices have been going up. And a few weeks ago, you could turn on like the radio or go on an internet news site or on TV. Um, and it was often a topic. Lumber prices are so high. So what has happened to lumber prices in the last month? Well, here's a chart of lumber prices, and yeah, you can see that the first part of this year they went up quite a bit, $1,700 for some amount of lumber. These are lumber futures, and it peaked early May. Well, it's dropped 50% since then. So this is where when everyone's talking about something, you want to be very careful and very patient, and consider going the other way. And that's when you want to be a contrarian, is when things are really extreme one way. Start to think about going the other way, and see lumber prices drop 50%. It wouldn't be surprising, no guarantee, to see something like gold drop 20%, 15%, 20%, something like that. And that would just be normal. And historically, that's certainly just the normal ebbs and flows of the price of gold, even in an inflationary environment.
Something that I remember from a class I took with you was the silver bubble we spoke about. What was it, like $2 to $51 or something like that?
Yeah, basically from I think under $2 to $50 over the course of the 1970s. Yeah.
And I remember specific, almost word for what you said is people were lining up to buy silver. And so when you see people lining up to buy something, that's when you go to the other line to sell,
Right.
right? When
Yeah.
you see people lining up, that is when you sell.
Yeah. Well, I knew someone that said it was 1980, January 20th, 1980. I mean, I saw both perspectives. I saw people just frantically buying silver because it's going to, go to $800. It's going to go to the same price of gold at the time. And I remember someone telling me that they went to the Bank of Montreal here in Winnipeg on that day to sell their silver, and there was just lineups, circular lineups around the bank for people that wanted to go in and buy. So that's really extreme. And what did we see? I mean, from that day, literally that day,
Silver.
was at $50. It bottomed about I think it was maybe 20 years later at $4 an ounce. So that's 90+% drop over 20 years. Now, I don't think we're there, but I think when you get into like things like cryptocurrencies, some of the cryptocurrencies, I think we're probably potentially at that level. That some of these cryptocurrencies, not all of them, but some of them, we're at that kind of point.
Okay. So we've established, that there's a strong discussion about inflation. So what does that mean for the value of the dollar? How strong is it going to be affected? We've discussed approaches to handle that. Do you want to elaborate on that?
Yeah, well, that's good. So there's a lot of forces involved when we're looking at investing in gold or gold mining stocks, and certainly the sentiment around inflation is one aspect where it seems like, wow, like everyone's talking about it. But now let's talk about the U.S. dollar, and there's a lot of similarities about um, the sentiment around the dollar. And generally the idea is the US dollar drops, the price of gold goes up, particularly because most people quote the price of gold in US dollars, but generally there's that relationship. Dollar goes down, gold goes up, or vice versa. Dollar goes up and gold goes down. That's certainly over the last, say, 3 or 4 weeks. That's what we've seen. The dollar has gone up a bit, gold has gone down. And, one thing, and I'm just going to, cut to a little bit of sentiment around the dollar. Okay. So this is kind of interesting. I'm going to show you a video of a fellow named Max Kaiser, who's done very well investing in gold and Bitcoin over the years. But he can get really excited, and he has a history of getting too excited at important inflection points at both Bitcoin and crypto and the U.S. dollar and so forth. So here's something from, I think it's just a very short period of time ago. So I'm just going to share my screen again. I'm just going to find. So this is Max Kaiser. It's going to take about 45 seconds, but he's doing an interview, and this gets a little bit of extreme. Maybe hide your children as we watch this.
To you right now. Okay, here's a $10 bill. This is garbage. This is garbage. Your people in South Africa, you have your rand, right? That's going to zero. That's going to zero. This is going to zero too. Euros are going to zero. Zero. The Chinese currency is going to zero. It's all going to zero against Bitcoin. If you don't understand that yet, you're going to be impoverished. You're going to be on the street. You're going to be begging. You're going to be out of business. You're going to be toast.
Max, do you know that it's a criminal offense to tear up?
Do you know that with the Bitcoin I have, I can buy any freaking senator or congressman I want? I make the laws. He who has the Bitcoin makes the laws, Rand. We're not going to just sit around and let the goddamn congressman tell us what to do. We've got the capital. We make the laws. We've got the Bitcoin. They don't.
Okay, so I think that's enough of that. But he did something similar to that back in 2018. And over the next few months, I think Bitcoin fell about 70% in price. So it's kind of just a funny little example of the sentiment out there. But yeah, go ahead.
I just wanted to say, just by presenting this little short clip, in no way are we emphasizing that, people who are really into crypto and Bitcoin necessarily think this way. This is one very extreme example, but we brought it into the video to emphasize a point.
Yeah, and that's really good, because I think it's reasonable to say that crypto is going to be around in some form for the rest of our lives, and in new forms and so on and so forth. So that's just kind of showing in some areas how that sentiment can get kind of extreme. Although I will say, I kind of alluded to this earlier, that some of these cryptocurrencies, Bitcoin, the idea is, it's limited. You can only mine up to 21 million. Most that'll ever exist is 21 million. So there's some scarcity, and that's adding to its value, that you can't print more Bitcoin. But a lot of these other cryptocurrencies, like Dogecoin or Dogecoin, however you pronounce it, even Ethereum, a lot more can be created. It doesn't have the scarcity aspect, but it's simply this association that it's crypto, and so it's going to do well. And it's really extreme sentiment in a lot of these cryptocurrencies. Not all of them, and not everyone has that same sentiment, and a lot of people are thinking about it the right way. But there's definitely, I'm getting emails from people saying, I have no problem putting, 30, 40% of my net worth into these cryptocurrencies. And it's extreme. And some of these, for sure, they're worthless. They're not productive assets. And some will probably go to zero. And it's reminiscent, there's this, a lot of people don't know this, but the great Kuwaiti stock market bubble, and I'll just touch on it very quickly, but you can read about it on the internet. But in the early 80s, there was lots of wealth in the Middle East, and this kind of side stock market in Kuwait, the prices just started going up and up and up. And it actually peaked. It was the third highest market cap of any index in the world, just behind the US and Japan. And it was like maybe 40 companies that were basically almost didn't produce anything or just produced a little bit. And people had made billions of dollars and they talked about how much money they had made. And it was all worthless companies. And eventually it went to zero. And that's what this moment in time feels like when I look at crypto. And a lot of the sentiment is you got to own crypto because US dollar is going to zero. And it's maybe that is the case long term. But as we talked about, in the 70s, you still get this ebb and flow, and you can still see huge corrections in the middle of huge bull markets. In fact, it's somewhat of a feature of large bull markets. So that's some of the sentiment around crypto that we're seeing, and I think that's just another sign that, hey, be careful in this current market.
So emphasizing the point that just because something goes up in value doesn't mean it is valuable. You got to be careful there, because just like those companies in Kuwait, is it? Yeah, went
Wait,
back to zero, went back to nothing in war. At some point, an index that was the third most valuable in the world after the U.S. index and the Japan index,
yeah,
right?
and this wasn't even the main Kuwait index. This was just some trading that kind of got going in a parking garage, and prices started to go up, and that attracted people and more people, and they just kept going up, and companies worth billions of dollars that were actually worthless. And again, I think you're seeing that kind of same dynamic in some of these cryptocurrencies.
Exactly. I mean, there's definitely some out there to consider, but like we've spoken in other podcasts, the test of time which gold has stood through, crypto is very new. It's 10 years old for Bitcoin, and that's the first one. And nowadays we get new ones coming out every day. We have thousands of new cryptocurrencies altogether. You don't know what's going to be what. Dogecoin, for example, was a joke, and everybody is saying that. And yet, it went up in value, I believe 22,000%. That's
Yeah,
huge. And it dropped half or even more over the past 3 months or so. We just
right.
don't know where it's going to go. It could be very risky.
Yeah, exactly. We're not like anti cryptocurrency
Yeah.
here. It's just recognizing the sentiment and the craziness and the historical market dynamics that are at play. That in this case, some of these cryptos are, it's on market dynamics are on steroids. But as far as medium to longer term investing, um, the signs are there of be careful at this moment.
So we've spoken about both sides of the coin. So inflation and then the dollar, or yeah, the value of the dollar. So let's tie that back to our main subject, gold investing, and how we can implement those new factors that we discussed in our podcast now into our strategy.
Yeah. So I think, what we've talked about lots in this podcast is, gold is very volatile and you want to be buying when it's down and maybe selling a bit when it's up, but not getting caught up when it's jumping up. Oh, I'm missing out. Right. And we've kind of seen that, right, in the last few months where gold was up $250, and lots of people were getting really excited and really aggressive. And now in a matter of a week and a half, 2 weeks, we've seen it drop, $150. So I think, be cautious. I think still be patient. These big swings and much bigger swings are historically normal. And one thing I want to talk about is not just gold, but gold mining stocks. And we've talked a number of podcasts about narrative bias and getting caught up in narratives, and but also just underlying market dynamics. There's just so many forces at play. And one thing that I do want to bring out is, gold mining stocks are kind of part gold, part stocks, part something completely, kind of do on their own. And that's good for diversification, but they do have this component that they are, to some extent like stocks in general. And one thing that just came out, it's been coming out a little bit over the last number of months, but they just updated it today. It was a company called GMO, which not genetically modified organisms, but this is an investment company called GMO. I think it's the initials of the founders. They've been around 50 years. They come out with these updates on their projected 7-year asset returns. They do it every few months, and they've had a great track record. Back 20 years ago in the dot-com bubble, they were saying, look, future returns are very low, negative returns. In 2007, they said, look, things are getting pretty crazy. We're looking at negative returns over the next, or at least maybe flat returns over the next number of years. Right again. So they've come out and said, basically their 7-year returns for US stocks are around minus 8% for the next 7 years after inflation. And I'll just show the graph on that, because I think it's pretty fascinating. Just got to find the. There we go. So this is as of May 31st. They just released it, and so this is, they look at different asset classes, international, U.S. bonds, so forth.
Can
And
you zoom in a little bit?
yeah,
Yeah. Oh, okay. A
there we
little.
go.
Okay, so that's the U.S. large or small, and then international, and then the line over there, it goes into bonds.
Yes, that's right. And they've got emerging markets and more, larger international markets or large cap companies in international. But the one we want to highlight is U.S. large and small cap. Projecting minus 7.8% and minus 8.4% after
That is
inflation.
almost times 4 everything else.
Yeah, and it's actually far more negative than anything they've ever published before, looking at other market peaks. So and this doesn't necessarily have to happen. They have a certain methodology that has worked pretty good, and the methodology here is that over 7 years, markets return to their historical equilibrium valuation levels relative to interest rates, and it might not work out, but it seems to me most people are betting that this is not going to happen. And I'm thinking, you probably want to at least be a little bit cautious that you're not betting 100% that this is not going to happen, because this is looking at minus 50% returns over the next 7 years after inflation. And this is just returning to equilibrium. If we went below equilibrium, it could be minus 60% or minus 70%, which is pretty remarkable. Again, don't say, oh, this is the end all and be all, but it's definitely, a scenario based on history and math. So this is a possibility. So it's these kinds of things that make me, somewhat, or maybe very cautious on getting too aggressive with new money investing in gold mining stocks, because there is this component that is going to fluctuate with stocks. So that's pretty dramatic stuff, and just more reason to have that portion of your portfolio that's still liquid, still in cash, that you can be use in the future. Who knows when? 3 months from now, 2 years from now. But it's definitely another kind of piece of the puzzle to say, hey, keep being patient with some of your investments.
Those bars just highlighted to me that over the past 11 years, 12 years, we just had a huge bull market, and a lot of people are caught in that, and they're not looking another way. And so, this is the time to say, hey, maybe we can look the other way and consider the opposite, direction, the possibility of that, and be there first, because you want to buy, You want to buy when no one's buying. You want to buy, when it's cheap, because if it turns out that it goes the other direction, it's going to be a lot more valuable.
Yeah, exactly. And you put it really well that, people, it's like everyone's looking one way. Hey, things are doing great. We're going to get inflation and stocks are going to keep going up, and, gold is going to keep going up. And, if you can, when it gets that extreme, that's when you want to start looking the other way. Whether it's people are thinking something's not going to do well. Okay, well that's time to buy, or vice versa. When people think everything is going to go up, be patient. And it's we're not saying sell everything or whatever. It's just like, hey, be diversified. And one way to be diversified is have a decent chunk of cash, or something like that, money market funds and so on and so forth, that you can take advantage. If that happens, it may not, or it may take a long time, but there's a lot of signs that we've talked about here where it's like, it's still, I know it's kind of a repetitive message that we've had, but be patient. And if we go back to when we were chatting uh, back in March of 2020, and I said, okay, this is a time to look at investing in gold for sure. No one wanted to talk about that, right? No one. Gold mining stocks, those are a horrible investment, and it was a great time to buy. I don't know. Maybe we won't get another moment like that, but it certainly feels like that's possible. And if we can be somewhat patient, a little bit patient for that, I think there's a decent chance that could come about at some point.
Okay, awesome. I think we had a great discussion today. It was really nice seeing you again and chatting with you. And to our listeners, if you have any questions, please feel free to contact us. I don't know the email by heart, but I will put it in the description. Yeah, with any questions or topics that you guys want us to cover in our podcast. And I guess just as a reminder, because we haven't said it in our podcasts in a while, Steve and I are not, professional financial advisors. So the content in this podcast series is, just to engage our listeners in our thought processes, and help them think of certain points in the realm of gold. And it's important to definitely consult a professional financial advisor and do your independent research. Awesome. Thank you very much, Steve.
Yeah, thanks. It was great talking to you. We covered a lot of fun stuff, and we'll do it again.
Awesome. Okay, goodbye.